that is actually rather important. If you looked at only cash, that would have skewed your calculation of, for example, enterprise value. You never want to look at just cash for enterprise value purposes, because companies may decide to do something with the cash. It also does make sense. I mean, these guys had a lot of cash before. They were just keeping it as cash, which has the least return for an asset. But this year, if anything, the interest rates on even short-term T-bills have increased quite a bit, so they may have put it in there. And why? Oh, these shouldn't be under current assets, but these are actually, long-term assets. Similarly, under liabilities, you got your accounts payable, accrued liabilities, deferred revenue. These are things that you actually have recorded as revenue, but you have not actually delivered the products. You have recognized it as revenue, which means it's a liability of yours. So actually, same thing with customer deposits. And that's about it. On the stockholders' equity, there is one item that we're going to look at. It's non-controlling interest. If the company has subsidiaries where they have, by law, they have to consolidate, but they don't have a controlling interest, you have to write that off as a non-controlling interest. Basically, it is part of consolidated shareholders' equity, but technically you don't own that. In this case, it's not a big percentage, but certain companies have a big percentage of non-controlling assets. You can actually view that as, let's call this non-controlling percentage. Divide non-controlling equity with total stockholders' equity. That's 2%. And the reason you would need that number, if you guys remember our calculation of enterprise value, we calculated as market value of the company minus total liabilities minus cash-like assets. But let me actually open that file. Let me see. The number we use for liabilities, when we were getting it from Yahoo, it was basically liabilities net of any minority interest. This percentage actually tells us what that minority interest is. If I'm looking at if I'm getting the total liabilities from the SEC statement, it doesn't say anything about liabilities that are coming from non-controlling interests. or minority interest. So liabilities net of minority interest should be basically liabilities times 1 minus, where are you? Let's actually look at the Yahoo numbers, see if they are indeed same or similar. Because I have no idea how Yahoo calculates it. That's one of the reasons I want to use the actual source numbers. Let's look at the balance sheet. It's quarterly. 9/21/520. Now I'm not sure Yahoo is actually reporting the correct number, because if you look at the balance sheet here, let me see. No, it doesn't say anything about it. That means I shouldn't have trusted the Yahoo numbers. In this case, this is a better idea. Remember, the market price that we're using, that's the price of one share of whatever stock you're using. So it is, by definition, net of any minority interest. So if you're calculating enterprise value, we need to actually make that correction. Same thing, cash-like assets, net of minority interest. Add the cash and cash equivalents and marketable securities. Sometimes they're listed as short-term investments. Again, unfortunately, there is no standard, so you kind of need to figure out from context what they mean and multiply it with 1 minus they still have about $650 million increase in cash, and that's typically a healthy sign for the firm if their cash is increasing, especially if that is increasing because they're not borrowing more. And if you looked at these guys, they actually have almost no long-term debt to speak of. They have some operating lease liabilities. And not much debt. You guys know the difference between operating lease and capital lease? They talk about it in your accounting classes. Do you know what a lease is for accounting purposes? What is it? Because for certain companies, this distinction matters. Just tell me what you think a lease is.
Where you're basically like renting something from somebody else.
Yeah. What's the difference between renting and owning?
Owning, you have equity in it, it's
Huh?
yours. If you own it, you have equity in it, it's yours. If you rent it, it's not yours, you're just borrowing.
Yeah, but for accounting purposes, there's a big difference. If I buy this computer to the company, it's an asset, I can actually write off the depreciation. If I lease it, I can write off only the lease payments. But those are actual cash payments compared to depreciation, which is not a cash expense. So there's a difference. The company that leases it to you, they actually own the asset, and there may be a buyback, condition. It's a 5-year lease. At the end of 5 years, you have the option to buy it at a certain price. But those guys actually write off the depreciation. For example, in high interest rate environments, leasing a car could be cheaper than buying a car. Why? Let's say GM finances leasing it to you. For accounting, for tax purposes, they own the car. So they write off the depreciation from their taxes. And they have to write the lease payments as revenue instead of writing the entire sale as a revenue. In high interest rate environments, that actually postpones or increases total amount of time it takes them to pay their taxes on it,